When we are close to all-time highs, it's obvious that crypto isn't a bargain. The question then though is, at what point in time is the market too heated that the current rally cannot continue? In this video, we're going to look at some data, we're going to look at some mathematical models that historically worked very well in the past and that might continue to work in the future as well. Of course, none of those models are perfect, but they do give us some kind of an anchor point because we have to make a call at some point, right? When we buy Bitcoin or crypto as a whole very cheaply and then it rises and rises further, we have to find a way how we can potentially diversify. We don't want to have 100% of our money in crypto, never have something on the side when prices are extremely heated. But first things first, let's have a look at the market value to realized value Z-score. So this looks at Bitcoin's current price relative to the average cost basis, as in what did the average investor in Bitcoin pay for their Bitcoin, and puts that relative gain in relation to the volatility of the asset. So how much does the asset go up and down? And so that's the orange line here. When we are in the green zone, then the current price is below the realized price. That's of course the best time to buy. But as said at the beginning of this video, we are obviously not historically cheap now. The question is, how much higher can we go? What's interesting is that over the cycles, it seems like even though the MVRV score does adjust for volatility, we still see those spikes rather declining over time. And we can simply just connect those tops. Then we get something like this. It's not a perfect approach, but it does show us that there's maybe some more room to grow. And this is a constant we will see for many different models going forward in this video. This model over here will not necessarily tell us where the Bitcoin price will top, but it does tell us what prices we are likely not going to reach. Again, we see the long-term Bitcoin price. This is the line in black. And then we've got the green line over here. That's the 2-year moving average of Bitcoin. It was again a good time to buy whenever we were below. But then there's also the cycle tops. That was a good time to sell. Now note something about those cycle tops. In the early days, we went massively above that moving average because Bitcoin was very volatile. We had this in 2013. We also had this to a lesser degree in 2017. And already in 2021, we barely reached that upper line. So it seems like from cycle to cycle, we have a harder and harder time reaching that 2-year moving average 5x multiplier. And so I don't believe that in this cycle we are going to reach the line. This is probably a hard ceiling and we are likely going to turn around before reaching this upper limit, which by the way currently is at $328,000. So if you're speculating to sell your Bitcoin for 400 or 500K within the next 12 to 24 months, you're probably making yourself a disservice. I do not think, just based on this model alone, that we are going to go that high. One of the major players in the Bitcoin ecosystem is the mining companies, right? The people that invest a lot of money into mining equipment that generate new Bitcoin regularly. Those kind of companies have to be profitable. But when they are too profitable, there's more and more competition and it becomes more and more risky to further expand the mining facilities. The Puel multiple measures how profitable are miners at the current point in time relative to their income 1 year ago. Surprise, surprise, this peaks when the price is also at the top. And interestingly enough, we have again some kind of a declining long-term trend. But we are not yet at the top of that trend. So there's still a little bit more room to grow. Throughout the cycles, the market tends to get more and more active, right? When we are at the end of a bear market, it's mainly just long-term holders that might dollar cost average into the asset, but there's not that much short-term speculation. There's not that much attention on crypto. As the price is rising, more and more short-term money comes into the market. People that normally are not interested in crypto, they suddenly start buying. And we can see a measure of that activity of short-term traders versus long-term holders in the realized HODL ratio. And again, this peaks when the price tends to be very high within a cycle. So that's when the long-term holders are already out, when only the short-term holders are trading. And that's then when there's just a little bit of volatility and the price doesn't directly continue rising, and the risk is the highest and we might enter another bear market. Interestingly enough, we again see those tops align. Now for this indicator, the tops seem to be aligning the best. Better than for the Puel multiple, better than for the MBRVZ score. The realized hodl ratio seems to work quite well. And again, it tells us a story that we are not yet at the top. So selling at 120k is probably still too early. Why do those crypto cycles exist in the first place? Why do we see these massive rallies and subsequent 70 or 80% crashes? The reason is people have to rebalance their portfolio, right? Over time, as the Bitcoin price is rising, as adoption is growing, and the long-term holders make more and more gains, the market is getting heated, a lot of short-term traders get into the market, things become less stable. But also because now all the Bitcoin is held by the short-term holders and the long-term holders have already realized their gains, the potential downward pressure on the price is also very large because, again, a lot of Bitcoin is not liquid. The market bottoms out when the long-term holders continue buying and when the short-term holders are all out, and it tends to top out when there's mainly short-term holders that trade all the time. Why do the long-term holders sell in the first place? It's because we can't have all of our wealth in Bitcoin or in crypto as a whole, right? Because of the volatility. We have to balance this out with something. And when we're already 5, 6, 7x up with our crypto, maybe we started out with 10% allocation, suddenly we've got 50% of our net worth in crypto. We want to take away some of that allocation, right? We want to reduce our volatility. Nobody wants to go down with their net worth by several years of income, right? Let's say you go from 2 years of income to 10 years of income just because of your investments. You don't want to go back again to 3 years because you can't save yourself out of that hole. You can't just make money, save that, and go back to 10 years. So the more money we have relative to our income, the more risk averse we naturally become. And so that's why the net unrealized profit and loss is such a useful number. When the market as a whole is in net unrealized losses, we definitely want to buy. But obviously now close to the all-time high, we are very far away from that. We can see how people tend to take profit earlier and earlier across the cycles. So in the past, people had to be on average 80% or so in profit to sell in aggregate. Here it was 76%, here it was 72%, recently 61%, and currently we are at 58%. So if you're suddenly going to new heights again, right? If you're suddenly at 64, 65% in net unrealized profit, we might again consider realizing some of that profit. Here's a nice illustration how the money flows from the long-term holders to the short-term holders during a bull run. This is the hodl waves, and it looks at all of Bitcoin's supply and how long did that supply actually stay in a certain wallet. So over here in gray, we've got all the Bitcoin that hasn't moved for at least 10 years. We can remove that from the chart. We can also remove everything with a minimum holding duration of 7 years, etc. We can go down further and further. And when we do this all the way to the 6-month mark, now we've got all the Bitcoin supply in percent that has moved within the last 6 months. And this goes up as the price is going up again because your grandmother is asking you whether or not it makes sense to get into crypto. So people that normally have nothing to do with crypto, they suddenly get in. And that's when this is at a peak, that's the time to be very cautious because the people that buy during a rally, they don't necessarily have fundamental conviction of crypto. They're not buying because they think Bitcoin is the safest of the assets, because it's the hardest of the assets, because they think it will be better than stocks and gold, etc. They're just buying because price go up. And the more of Bitcoin is held by such people, the riskier the market becomes, because when price isn't going up anymore, they are simply just exiting very quickly. They have no fundamental conviction in the asset. And currently, this is a good sign. We are not necessarily that high on that metric. So the market isn't really heated. It does make sense to continue holding. I do not think that 120k is the top of this cycle. Instead of looking at the holding, we can also have a look at the realization of profit. We can do the exact same exercise. Again, remove the long-term holders. Just have a look at what happens to the wallets that realize their profit within the last 6 months. And again, we are not yet at a high level here. Now, all the charts that we looked at in this video so far were some macro charts, as in we can time the market maybe on a scale of several months, potentially years. But if we trade a bit more actively, let's say we do a trade every few weeks, is there potentially a point in time where we can take some profit? I think a useful metric here is the stablecoin dominance. So this looks at the entire cryptocurrency market cap, and it measures how much of that market cap is currently risk off or in stablecoins. If a lot of stablecoins have already been deployed and the stablecoin dominance is low, there's not a lot of dry powder on the side, we might consider selling. If there is a lot of dry powder on the side ready to be deployed, then the crypto prices tend to be low and it might make sense to buy. So let me show you what I mean. This is the stablecoin dominance. And what we see here at the bottom, that's the price of Bitcoin. And we can already eyeball this. When the price of Bitcoin is low, then the stablecoin dominance tends to be high. When the price of Bitcoin is comparatively high, then the stablecoin dominance went down. And in the last 1.5 years, we tended to trade in a range between 5% stablecoin dominance and 9% stablecoin dominance. So we would sell over here, we would sell over here, and we would sell somewhere in the future over here. So that's corresponding to a Bitcoin price of 72K, where we subsequently went down 26%, or over here at around 100K, where we also went down to a very similar degree, 25%. And so right now we are not yet at the bottom in the stablecoin dominance. Thus, again, I do not believe that 120K is the top of this short-term move. We're currently at 6% stablecoin dominance. There's still a little bit of dry powder on the side, and there might be a short-term temporary top once we go to the 5% mark. And then, if you're a lot in leverage and you don't want to digest a 25% drop and you're trading more actively, it might make sense to realize some profit over here. Now there's the approach to simply just buy into Bitcoin long term, right? To buy, say, once a month to dollar cost average in, say $1,000 every month. And that is a winning strategy because there is a lot of volatility, and the more volatile an asset is, the better it is suited for regular purchases. And had I done this, I would have gotten this light gray return. Instead, I outperformed just dollar cost averaging into Bitcoin. I got this black line in return. The Bitcoin maximalists say that we should forget about all of the altcoins and that Bitcoin outperforms the altcoins most of the time. Everything goes down against Bitcoin long term. So in the end, just stick with Bitcoin. That's what the maximalists say. But I think it's better to actually take advantage of this market asymmetry. Because while the Bitcoin maxis are right that most altcoins underperform Bitcoin most of the time, and that trying to find the next 10 or 100x meme coin is a losing battle long term, while this is true, we can still take advantage of that underperformance. The altcoins tend to do so poorly because of supply expansion. So users of the platform of the altcoin, or maybe the early investors in the token, or maybe the team, they get token unlocks. They get more and more tokens available over time, and they might dump those tokens on the market, depressing the price. For example, here, this is the circulating supply of the balancer token. It's a very typical DeFi token. We see this typically across the entire altcoin market. And if the supply grows faster than the demand, of course the price has to come down, at least relatively speaking. And so this is then the balancer price relative to Ethereum. It just goes down all the time. And we can flip this. We can take advantage of this. If we go long Ethereum and short balancer, or if we take out a loan in balancer, swap this into Ethereum, we get this return here. And that's how I made this outperformance over buying and holding Bitcoin. I shorted poor altcoins and went long Bitcoin, Ethereum, and Solana. And in this video, I actually want to share this for free over here. How can we get this kind of return? How did I achieve this kind of return in the past? There are several approaches, and I'm sharing now the one that I'm using for several years already. Go to the platform Aave. So that's aave.com and open the app. Over here, you can borrow several tokens. So you're providing some kind of collateral. It's a borrowing and lending platform. You provide collateral and then you can borrow against that collateral. And what you want to borrow is the balancer token, right? That's a token that tends to go down versus Ethereum all the time. Thus, if we borrow balancer, if you've got a loan in balancer, and we then swap that balancer versus Ethereum, and then we wait for Balancer to continue to go down versus Ethereum, we suddenly have profit, right? Our loan, our debt is going down in value. Our asset is going up, relatively speaking, and then once we want to lock in our profit, we just pay back the loan with the appreciated asset. It doesn't cost much at all to borrow Balancer. It's 0.31% per annum, yet the price is going down so consistently. I made tutorial videos to the premium members about this strategy in detail in the past. And again, it was a very nice moneymaker. This is why people stay subscribed to premium, because the membership basically pays for itself if you've got some capital. But I found an approach that's even better, and that's currently my focus. I started this out 2.5 months ago. It's again relative valuation bets, but it's not with borrowing and lending platforms, it's instead with perpetual futures. I started with 40k, and then after 2.5 months, this turned into 60k, so 50% return. I don't expect that the growth rate will be that strong going forward, but still, I do think that in general, this is a winning strategy, right? Simply because the insiders, etc., they cash out over time, long term, and depress the price. The problem with perpetual futures is that we need to be very diligent around our risk management. We have to use very tight stop losses, and we then have to adjust those stop losses regularly. We have to find the asset that's most deflationary, that might have seen a short squeeze, etc. And while I'm sharing all the trades that I personally do, many people don't have the time to copy trade. And so I got asked regularly by the members, can't you just provide some kind of liquidity pool? We provide money to that pool and then you trade for us. And I finally started this just 2 days ago. It does not use Aave, it does not use borrowing and lending platforms. Instead, it uses Hyperliquid. And this is a tutorial video on how to use the Bitcoin strategy copy trading vault on Hyperliquid. So that's this platform over here. The platform is growing massively. So in less than a year, it attracted almost 2 billion worth of value. And I've created a vault, so a capital pool where the annual members of Bitcoin strategy can deposit to and then simply get the same kinds of returns. If you're just starting out and you've got some time and you don't have that much capital yet, then you can do this all manually, right? You can just go through the tutorials, you can watch them and then learn how to do this all yourself. I am sharing my own trades as well, and there are plenty of people that do this very successfully in the community. So if your crypto portfolio isn't yet $5,000 or $10,000, it's below that, then it makes sense to just go with the monthly membership and do the trading yourself. But if you don't have time, if you've maybe got a business to run and you've got way larger amounts to deal with, you don't want to hassle with all the risk management, etc., then the annual membership is for you. Because for the annual membership, where by the way, you're also saving a bit of money, you get access to the copy trading vault as well, with all the instructions on how to actually deposit your funds. And while I cannot guarantee that we make another 50% in the next 2.5 months, I will do my best to achieve positive returns. This strategy has outperformed buying and holding Bitcoin for more than 4 years now. And I don't see any reason why it shouldn't do the same using perpetual futures instead of borrowing and lending platforms that we used in the past. A link to Premium should pop up directly over here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers!